Welcome to Trading Day. I'm Amber Canwar. A lot to contend with right now. Let's start with one of our top stories, which is the Bank of Canada cutting its key interest rate for a second time in a row this morning and suggesting that more rate cuts could be coming as long as, of course, inflation plays along. Let's bring in David Rosenberg, founder and president of Rosenberg Research, joins us now for his perspective. Thanks so much for being with me.
Thank you, Amber.
Great to have you on the desk. So let's get into it. Your 2 cents on what the bank did today. It's the right move?
100% the right move. And as you correctly said, there's going to be more cuts coming. I would call this unequivocally a dovish cut. The bank gave forward guidance that you gave the comment about if inflation continues to behave. Question is, why wouldn't it? I mean, the bank gave this to us on a silver platter because what did they tell us? They told us not once, not twice, 3 different times in the press statement that the Canadian economy is operating in a state of excess supply. So you don't need a course in economics to know that when supply is running above demand, what happens is that puts downward pressure on inflation. And in fact, when you look at their forecasts right out to 2026, the Canadian economy is going to be operating in this excess capacity environment right through the next 2 years. What's inflation going to do? It's going to continue to come down, and rates will come down alongside with it, much more than I think than the markets have priced in.
Well, let's unpack that. How low can we go? Because I think consensus is, yeah, we're going to get more rate cuts. Maybe we hang out around 3%. But your number, I looked in your notes this morning, was 2%.
Well, let's put it to you this way. What did the Bank of Canada tell us? It told us that the economy is in a state of excess supply. Like I said, these 3 times, that's major emphasis. So what is the equilibrium interest rate, the appropriate policy rate for an economy operating in an excess supply environment, which, by the way, based on the Bank of Canada's own GDP forecasts, that output gap isn't going away in the next couple of years. Yeah. So the appropriate interest rate is 2%. And you look at the bank's own definition of where neutral is and their midpoint of neutral. Neutral is this nirvana world where we're at price stability and full employment. 2 3/4 is the midpoint. So you said 3. I'll take the under on 3, but I think just looking at the bank's own forecast and tracing out what it means for the unemployment rate in the next couple of years and inflation, rates are going to go down a lot more. And I think 2%. And I'll tell you what, when we get down to 2%, then you'll have me on the show and we'll talk about it. We're going to go even lower than that.
Really?
Well, because I'll tell you why. Because
I thought we're done with that. We're done with that world. Remember, everybody says that.
Well, we're not going to zero.
Okay.
But let's just put it into a certain perspective here. We have the unemployment rate at 6.4%. It's up 160 basis points from the cycle low. And that hasn't come through job loss, yet. That's come because we have throngs of people coming into the labor market. And in fact, in the past year, fewer than 60% of the people that came into the labor market actually landed a job. That was 80% last year. We're down below 60% in terms of the people finding a job. Well, that in and of itself is going to put downward pressure on wages, but we haven't even had the layoffs yet. So when we trace through what the Bank of Canada is telling us about GDP growth, their own growth estimate benchmarked against their own estimate of where potential GDP growth is, that takes the unemployment rate in Canada in the next 2 years up to 8%. And it takes inflation down to 0. So when I say that we're going down to 2%, I mean, you said 3. I mean, 2 3/4 is a no-brainer because that's just where neutral is. And the economy is no longer in equilibrium. We have growing excess capacity, especially in the labor market. And almost every underlying inflation measure is moving into the Bank of Canada's target range. So we're not even in that nirvana world. The nirvana world would say to you, Amber, that the overnight rate should be 2 3/4. We're not. But we're still like 175 basis points north of that. And then what I'm saying is that their own forecast is telling us that by the end of 2026, we're still left with a deflationary output gap. Now, they're not going to come out and tell us unemployment's going to 8%. But when we run through the numbers, classic Okun's law, that's what we get. And inflation goes to 0. So you tell me, where does the overnight rate go? Because historically, the real policy rate, inflation adjusted, is about, call it 1 to 1.5%. Inflation gets to 0, where are we going? So what I'm saying is we're going to get to 2%. That's my call. And I'm not nervous that it's too aggressive, because I think that when we get there, we might be talking about going below that. And that's why people say that I'm some sort of radical perma bear. No, 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 no. I'm a perma bull on rates.
On rates, but I do have to talk about your forecast on unemployment. That is, eye-watering for a lot of people to say that it's going back up to 8%. That's very elevated. You have to be thinking about a severe economic contraction, no?
Yeah. Are we going to have a recession, or are we in a recession? Right? Because when you're taking a look at the jobs market, you look at the unemployment rate, and there's something called the SAM rule. Claudia Sam, we all talk about the SAM rule. Well, it's almost borderline flashing the recession signal in the U.S. I think when we get the next employment data next week, it's going to flash that when we get the July numbers. In Canada, we've had the SAM rule flash the recession signal for some time now. So yeah, I think you're 100% right. Look, we have a crisis in this country that nobody talks about. Let me just explain. Everybody complains about government balance sheets, about fiscal policy. The crisis is on household balance sheets. I don't know how we got here. Nobody talks about it. That you know what the household debt to income ratio is in Canada? Do you know what it is? 160%. It's 90% in the States. 160%. We are 30 percentage points higher on the debt income ratio in the household sector, 30 percentage points higher than we were at the bubble peak in the mid to late 2000s. Look where rates went in the US after that. Like, we have a huge bubble on Canadian household balance sheets, and they can't afford these level of interest rates. Like, when you're taking a look at the most stark upward sloping line in this country, it's the interest payments that are being drained out of after-tax income.
So I want to just hold these arguments, because if you're saying that the rates are going to come down, does that not help the unemployment picture? Does that stop us from going to 2%? Does that help keep the bubble on the debt side from bursting?
No, because look, we're talking about the cycle here. It's like, we're talking about, the dog and its tail, what's chasing what. So of course, what's happening now is we're paying the price for the aggressive interest rate hikes by the Bank of Canada over the past couple of years. And that operates with a lag into economic activity. And we're seeing basically we have over 3% population growth, can't even generate a 1% GDP stream in this country. It's pretty pathetic. The economy is very weak. So, the bottom line is that we have a situation where interest rates have to come down now, and I think even more aggressively, to prevent what could be a catastrophic debt default cycle. Yeah, so you're asking me.
So they should be cutting by 50 basis points if this is the outlook.
Well, I've been saying that. Look what, see, this is what bugs me, okay? Is the bank now is talking incessantly. This is the third meeting in a row where they're invoking these two words, excess supply. Those are big words from a central bank. But you see, the Canadian economy actually went into this excess supply backdrop exactly a year ago. What did the Bank of Canada do? It raised rates twice.
But they couldn't risk because inflation wasn't participating.
Well, inflation, yeah, and all of a sudden, you're taking a look at, you strip out the nonsensical mortgage interest. I don't know about you, when I go to the shopping mall, I don't see mortgage interest on the shelf, but inflation is 1.9. You look at the CPIX, which excludes the noise from the 8 most volatile indicators, 1.9. So the people like myself, by the way, that were saying it was transitory, and I know that eyes are going to roll, but you know what, in the overall annals of economic history, 18 months is pretty transitory. So I think the Bank of Canada overreacted. I think a lot of these central banks overreacted, but you see, the thing is that they kept on raising rates into the exact environment they're talking about. They didn't talk about excess capacity last year, talking about it now. All they've done, we're meeting today because the Bank of Canada cut rates. They cut rates 6 weeks ago. The two rate cuts, the back-to-back rate cuts, all that's done. All that's done is taken away the two mistakes that the Bank of Canada made this time last year.
I got to ask two follow. If this is your view, then this has big implications for how you invest in the equity market. Banks, retail, specifically in Canada. This is not a sector that you want to look at. And financials recently have started to perk up. Is that kind of how we take that economic view and translate it into equity performance?
Well, I'm worried. Once again, I think we still have a default cycle ahead of us. And the question is, have the banks reserved enough? That's an open question, okay? And it depends on how severe the recession is going to be. We've already had the unemployment rate go up 160 basis points, and there's been no job loss. What happens when we start getting the job loss? So I talked before about when I trace through the Bank of Canada's numbers and I get 8% on the unemployment rate, not overnight, within the next 2 to 3 years, that's going to put downward pressure on wages with a lag. That is going to impair debt servicing capacity, which is why the bank's got to cut interest rates aggressively. Now, in terms of your previous question, yes, interest rates coming down with a lag will produce the next economic recovery, so 100%. But let's just stick with the here and now and maybe what's going to happen over the next year. I think that it's too late. And the bank's going to have to cut rates a lot to generate that future economic growth down the pike. So in terms of the stock market, yeah, you can argue that a renewed steepening of the yield curve should be positive for the banks, absolutely. But you tend to find when rates go down, the bond proxies, what I call bonds and drag, and the stock market tend to do well. What am I talking about? Pipelines, utilities, select REITs, even telecom. Yield-sensitive dividend growers, dividend payers, dividend yield tend to do much better when rates are coming down, and that's where you'd want to probably deploy your money if you're going to be all in on the stock market.
We can't talk about Canada as an island, of course. While this is happening in Canada, we're going to 2%, unemployment's going to 8%. What's happening in the U.S.? There are growing calls, it seems, for the Fed to cut rates sooner, not even wait till September. Is that going to happen? How far afield is Canadian central bank policy going to go from U.S. central bank policy? How does that show up in the currency? All these questions.
Right. Well, look, last I saw, the Fed and the U.S. economy is not one of the Bank of Canada's mandates. Okay, so, and it's not the first time the Bank of Canada has gone it alone. And so.
But isn't there a limit to how much they can deviate?
Well, the Canadian dollar will tell you. I mean, you said at the beginning the Canadian dollar is down, but it's hanging in reasonably well. It's 72 cents. So dial me up when it's at 62 cents, okay? So basically the Canadian dollar will dictate the extent to which there'll be a price signal saying that the bank has gone too far. The reality is that the Canadian economy is not the U.S. economy, okay? We do not have 30-year fixed rate mortgages here. Interest rates reset much more quickly here, and we're still feeling the pain of what the bank's done in the past couple of years. We don't have the same fiscal stimulus here. What's the federal budget? I mean, we all lament about what's happening in Ottawa, but the deficit's like 1.5% of GDP. Where is it? Where is it in the U.S.? Like 6.5%. So they have much more fiscal stimulus still lingering in the U.S. economy, and they've been sheltered, the household sector, because everybody locked into those 30-year fixed rate mortgages. So their economy is slowing down in the States. It's now basically, I call it 1 to 1.5%, so it's down to stall speed. The inflation numbers there, like in Canada, have been moving down. So all of a sudden, the Fed's got more confidence than they had before. They had, for a temporary period, lost their confidence. But I was saying that a lot of the inflation bulge at the beginning of the year were really idiosyncratic factors related to insurance premium, whether homeowner insurance, auto insurance. But that's fallen by the wayside, and now you're seeing the true picture. Inflation's come down a lot more in Canada, but it's coming down in the States. And so I think the Fed realizes that their actions operate with lags, and everything they're going to do now, same with the Bank of Canada, when you're talking about, well, the future recovery, well, that's going to be 2 years down the road, okay, because it takes time for interest rates in both directions to percolate through the economy. But yeah, I think what's going to happen, I think the Fed should cut rates at the next meeting, but they're not going to, because that'd be too much of a mea culpa. However, I think they'll set the table. The market's already priced like 95% for a cut, so there's not really much that they have to do. And Jackson Hole, Powell probably will again nudge the market more towards that. And I think the Fed will cut rates 3 times. I think they'll go September, they'll go November, December, and much like Canada, I think that rates are going to go down. I mean, they'll go down to at least 3%. We're not going to end this cycle in the U.S. without rates getting to or below their own estimate of where neutral is. So I think that short rates there will go down below 3% as well.